Hi, what's up guys? I'm Edwin. We have to make a lot of important decisions in our life. If I ask you, what are the most important investment decisions in your life? What do you think? I would say that there are 5 very important investment decisions in our life. First and foremost, education. We spend most of our time in school to learn, and a lot of money has spent on schooling. From an investment perspective, there are many things we need to consider. For example, whether we should study a master degree, should we study abroad, or as technology is so important in the future, shouldn't we study science? The above questions are all interesting, but let us discuss it later in other videos. The second one should be your career choice, as we could spend 40 years in working for a 20 years old guy. If he chooses to work in a growing industries versus in a declining industry, it could make a big difference in his life. So of course, there are also other things that we need to consider. For example, interests, abilities, and opportunities. And next, the third one would be property. We need a place to live. So property is the most common asset that people invest in it. Related questions including when to buy, at what price to buy, and where to buy. The fourth one would be how to invest your liquid assets. Wow, then there are a lot of choices from low risk like demand deposit, time deposits, principal guarantee product, and bond to medium risk like real estate trusts, stocks, exchange trade funds, and mutual fund, and to high risk like hedge funds, cryptocurrency, and derivatives. Many of my friends have spent a lot of time in investigating how to make a better stock picking or think about education, career, and property purchases. But how about the fifth largest investment decision? It is actually as important as the previous four, but unfortunately, I seldom hear people to do research on it. I would say that even when I was young, I didn't care about this decision, but now I know that it's extremely important. So please don't just ignore this. And what I want to talk about today is MPF. MPF is a retirement policy implemented in Hong Kong. Employees working in Hong Kong will invest 5% of their monthly salary in MPF every month. The employer will also deposit an additional 5% into the MPF account. After that, employees can choose to invest the fund in their account into different funds among the trustees chosen by the employer. And finally, when they retire, they can get back all investment in their MPF accounts. This just one click on the funds you invest can actually change your life. Unfortunately, many employees in Hong Kong have overlooked its importance. So let me explain it to you why this decision is so important. The following are the annualized returns of different fund types. The green bar indicates 10-year annualized return and the blue bar indicates 5-year annualized return. Since the 10-year period is more representative, we will focus on the green bar first. The length of the line represents the return distribution of funds belonging to a specific category. So they are the same type of fund, but they are investing in different markets and are managed by different trustees. For example, taking 5-year stock fund as an example, the return of the poorest performer fund can be as low as negative 0.18% per year, but best fund can actually achieve 21.45% per year. So even if we know which fund category we should focus in, we still need to make decision on which fund to invest. But it is another difficult question, so I would like to discuss it in next video. So let's get back to our topic to date. We assume that the middle point of a bar represents the average return of this category. So based on this assumption, you can see that the return of stock funds is about 6.6%, which is 1.8% higher than that of mixed fund. Mixed funds are those who invest partly on stock and partly on bonds or other instruments, the weighting depending on the funds and its managers. We can see that mixed funds perform better than bond funds. The difference in returns partly attributes to the differences in risk exposure. So the MPFA has already ranked different fund types according to their risk exposure. from higher risk like equity funds, mixed asset funds, bond funds, and then down to guarantee funds and money market funds. One point worth discussing is that the return of investing in bond funds, guarantee funds, money market funds are so poor. You may think that a few percent difference is not that important, but the cumulative return for 10 years could be a huge difference. Not need to save for 30 to 40 years. In these new figures, we can focus on the 10 years return, which is the green bar. Assume that the average cumulative return is in the middle of the bar. We can see that money market funds have a cumulative return for only 3 to 4% in 10 years, which is so low. And it's actually lower than the inflation. So in other words, conservative funds provide negative real return to investor. It means that this investor not only cannot improve investor financial position, but also need to decrease in purchasing power over time. Compared with stock funds, many people prefer mixed funds. I guess one of the reasons is that we always believe that mixed fund, which is a combination of bonds and stock, seems to get the pulse from both sides and provide better investment performance to investor. But what we can find in this figure is that the difference of only 1.8% in return can make a huge differences in cumulative returns. That's why I would suggest you to consider to put your money all in stock funds rather than put in the bond funds or in mixed funds. Let's just take a look at the 5 years annualized return for various fund type over 5 years. The stock funds performed quite well in the past 5 years, which give an average return of 9.7%. It leads to a 1.9% better return than mixed funds. As you can see, money market funds, conservative funds, and guarantee funds cannot protect investor wealth from inflation. Their real returns are all negative. It means that purchasing power is actually decreasing over time. Bond funds, after subtracting inflation, provide investors with a real return for above 1.5%. People have different beliefs and preferences in allocating their money to different funds. Some people all in mixed funds, some people want to have 50-50 or one-third. My suggestion is that, just as the same is my previous video, I agree with Warren Buffett's recommendation. Investor can actually invest 90% in a well-diversified stock fund. For me, I think for MPF, it's perfectly fine to invest 100%. But remember, when you pick this type of stock fund, you need to ensure that it is a well-diversified enough so that you can achieve a very good risk-return trade-off. Some investors may worry about, is it too risky to all in stock funds? Sometimes we have a misunderstanding on risk to believe that we should achieve the lowest risk if possible. In financial market, we always have to make a balance between risk and return. So when we accept lower risk, the consequence would be lower return, like performance in money market fund and guarantee fund. So how to get a good balance between risk and return? First, you need to come up with an individual highest acceptable risk level. And then under this constraint, we will try to maximize the return as much as possible. Just like when you're eating some snack, or drinking soda. It's bad for your health, right? But as long as the amount is controlled under the benchmark, you can still have a happy life with snack and soda without posing a problem to your health. But the same token, as long as you invest in a well-diversified stock fund, even 100% invest in it, the risk exposure will still be acceptable. For example, S&P 500 index go up and down in the past 40 years, but stock market bounce back every time after it drops, providing investors pretty good returns over a long run. As MPF is an investment for decades, the long investment horizon already provides a safety net to investors. Even in the worst case scenario, an employee starts to make investment in S&P 500 stock fund in 2000, the MPF monthly contribution system make investors to adopt dollar averaging strategies. So when stock fall, investors can actually buy more shares at a cheaper price. And then when this fund operating up to 2021, we can see that the investor can still enjoy pretty good profits of about 100% return. A return is much higher than bond funds without posing any actual risk to investor. The reason is that employees are only allowed to draw money from MPF at retirement. Therefore, the volatility in between is not really a risk to the investor. Another way to understand it is by the mathematical equation. So although both risk and return will increase over time, but the return is rising at a constant rate, but the risk is increasing at a decreasing rate. Therefore, when the investment period is more than 10 years, the return to risk ratio of stock funds will become more attractive. Always remember that time provides the best way for us to deal with risk. Therefore, we do not need to overdo the risk control to invest in low risk product by sacrificing our returns. Finally, someone may want to ask, what if I'm going to retire after a few years? Should I still invest in stock fund, or I should actually invest some in bond funds? My answer is still the same. To suggest those investors to all in stock fund. Why? The reason is that now our life expectancy is above 84 years old. Assuming retirement age is 60, there are still 24 years to invest. Therefore, when you take out your money in MPF account, it's not the end of your investment, but instead it's just the beginning of your own investment. So under the expected investment period of more than 10 years, I will still suggest stock fund to you. So even the stock market crash, when you get back your money from MPF account, you can then instantly invest the money to a well-diversified fund like S&P 500 fund. From the history, we know that stock price will still go up again and break its record, just like the sharp rebounds after the big drop in March 2020. On the other hand, the low returns on bond will make investors unable to generate enough income from their retirement consumption. So therefore, they need to sacrifice their living standard. This drawback is much important than the risk of relatively high volatility in stock funds. Okay, so that's the end of today. I hope everyone can consider their MPF decision and position. Even if you don't want to make a change right now, I still recommend you to start to take a look of your MPF account and balance, and then take a look of how will it perform if you at the very beginning invest all in your stock fund. So see whether it makes a big difference on your closing balance. And in the next video, I'm going to share more about MPF. So I'm Edwin, thanks for watching, and I'm looking forward to see you again in next video. Bye!